Hi, this is Randy Finney with Right Side of the Chart, and today is Thursday, December 9th, 2021. It's 1:47 p.m. Eastern Time as I'm starting the video. So a little over 2 hours left to go in the trading day, so just over another trading day. And then some left in the week. So I want to do an update on the equity markets, and we'll just stick to the equity markets in this video, so it won't be too long. I'm going to start out with the short-term frames, and then walk out to the go all the way out to the longest-term monthly frames. We're not going to look at too many charts, but just wanted a quick update here. So here's a rally. I recalculated today. So 5.6%. In the video I did yesterday, I showed you that again, assuming that we're going to get another leg down, this is nothing more than a typical counter trend rally, which is right in line with previous rallies, especially the initial, what I call the first tradable rally. These are little zigs and zags. You could day trade them, but as far as swing trading, it's worth it if you can get 4, 5, 6% on a quick swing trade, get out. And again, it may be the start to a lot more. Maybe we pull back here and go up, but or it could be what I'm still leaning towards. So we had those sell signals recently. I'm going to address those on the daily and weekly charts, and then look at some things on the monthly chart that are definitely worth noting. So that's that. Let's not read too much into it, what happens, no matter what happens today, but I will be interested to see what happens tomorrow. Now, tomorrow could leave us with somewhat of a cliffhanger, or what I'll call non-indeterminable candles, and I'm mainly referring to the weekly chart. I'm going to get to that in 1 second. But before I leave the 60-minute chart, let me show you what we have. We have, I won't go over all the sell signals we've had recently because I've done that quite a bit. This is just one of many charts where we rallied up. We retraced a little bit over the 61.8 Fibonacci retracement, fell shy. We came about halfway between the 61.8 and the 78.6% fib is where this rally stopped so far. And again, 5.86%. We got for pullback. Even if you're looking for the bullish case, I'd say at least you get a pullback to backtest the top of the gap, possibly the bottom of the gap. So those would be maybe objective long entries if you're a bull wanting to go in. If you want to look at the bearish case, well, we're pretty much pushing the upper limits. One thing to note about this rally is so far we did not take out these two previous reaction highs. We came a little bit lower, so you have again what is the potential makings of we're still in a near-term downtrend until we take out, I'd say, both these two. This one's a little bit higher right here. Then that's what that is, a series of lower lows and lower highs. So again, let's not read too much into it. Let's see how the week finishes. There's your near-term pullback targets. And before I leave this 60-minute chart, let me just point out we also have what I call a high-level bearish PPO crossover. I have a level up here at about 0.64 on the PPO, and you can see we had a high-level crossover there. We were in an uptrend. It resulted in a little bit of a pullback, very mild correction, but nonetheless, we corrected. We had another one just below that line there, and that led to this drop here, or preceded that drop. Then we had one there, pull back, and this was early after the correction was over. And remember, we had positive or bullish divergence at that low. So at that point, you really, it's going to burn through. These signals are going to have less of an impact. But that one had a pretty decent pullback. This one, not as much. We had a high-level bearish PPO crossover, and we did drop, at least for a couple days there, a few days, I should say, and certainly a noticeable drop. Next one came right there. Last one came right here, and now we have this one. So there's that, and that's the case to maybe maybe be short right now, especially as an active trader, day trader, and stop right above the highs, swing down, targeting at least the top of that gap, if not the bottom, or as a swing trader, maybe this is it. Like I said, I'm not crazy on how high this rally's bounced, but it's still, again, I've been talking about it now for 2 days, still within the realm of normal counter trend bounces. All right, let's look at one other board, 60-minute chart, and that's it. So we hit, just to recap, sell signal here, 1, sell signal here, 2, bearish engulfing candle there on the 60-minute chart as well as the daily and the weekly, and hit my first and then second target, and a counter trend rally so far. So still favoring a move down to T3 and T4. But again, that starts to, the odds start to really decrease once we take out 401, because that's the previous reaction highs right there. And again, define your, your time frame trading style. You might be all out bullish and bought all these dips and think we're going up, and again, great. So far, if you grab T2, reverse short or went long there, great. But what I was going to say is that any new high, particularly on the daily chart, and even here on the 60-minute chart, possibly, we'll see what happens, will still be a divergent high. So if you're holding out for a much bigger drop, you can certainly allow a move up here, from the previous high right there. A marginal new high of 1% would look like that. Yeah, that's all I could drag. I'd have to go down here, look like this, 3%. That probably better to look at that on the daily chart. Let's get there. I'll get to SPY and IWM when we get to the long-term charts, but daily chart. Okay, remember, this is the bearish engulfing candle, which was confirmed with a lot of downside afterwards, and we're still well below that. In fact, all we've done is rally back to the bottom of that candle, which is also the breakdown point, that last sell signal right here. So if you miss this one, you miss that one, and you wish you were short here, again, we're kind of stretching the limits. I'd say you could certainly make a case for an objective short. Just keep, I just told you, 401, keep your stop somewhat below there, and you could certainly make a case to short, or see if we roll over and start to move down impulsively. For example, if we go into this gap and then take it out, that's going to be bearish, because again, any dip buyers should, and that's quote unquote should, doesn't mean they will, should be buying pullbacks to the gap, the top and or the bottom of the gap. And then we already tested, remember, we already tested 382.81, so that was a level where I mentioned if you are bullish, that's nothing but a breakout and back test of the previous breakout of all-time highs right there above that level. So that's still in play. And so the bullish scenario says you got a great entry there, maybe one of the best for a while. But like I said, this is the daily chart. Here's the divergence line right there. We had divergence at the recent high. And that was that bearish rising wedge. Any marginal new high, marginal being, again, equal or a hair below, but ideally equal or a little bit higher. There's that's what it looked like if we went up 3%. You'd come all the way up to about that'd be about 420 right there. That's 2.86% above the previous high, and if it happened relatively soon, it would look like that. And then this indicator here, the PPO, would come up like that, and the RSI would come up, and you'd extend the divergence. So again, it's I think there's minimal upside from this point in time in the markets. And that is before we come back to check this longer term uptrend line and or the 200-day moving averages, which have not been visited or tested in quite some fact since we regained them back here when COVID first hit in early 2020. We broke below them and then regained it thanks to the Fed pumping up both the Fed and Washington bumping up the market and the economy. Okay, next up, that takes us to the weekly chart. So this is what I'm talking about. Let's see, I'm not trying to read too much into what happens today or tomorrow, because we're not at a level anything significant is going to happen unless we had a huge move up or a huge move down. And again, tomorrow may be what I call an indeterminable candle. It doesn't tell us much. We had the bearish engulfing in both QQQ and SPY week before last. This is last week's candle right there. There's week before last, and there was our bearish engulfing. It engulfed these previous candles right here, those two, the body of both of those candles. Follow up with confirmation on a red candle afterwards. But so far, would be, like I say, redder the better. It was a red candle, nothing huge. It would have been really helped the bearish case to see another red candle this week, and so far that doesn't appear to be the case. In fact, we're going to have to reverse. This is where we're trading now at the top of the body of that green candle. So between right now, with 2 hours to go in the trading day and the close tomorrow, we'd have to come down and take out the bottom of the candle, which would show where it opened the week, and that's about a 3% drop. Certainly doable, but just right now that's not what it is. So we'll see what happens tomorrow. And so without a green check mark there, but with a green candle there coming back up, it's still not violated or taken out the top of that previous bearish engulfing candle, but right now it's Not really an X, more of a question mark again. Let's not read too much into that. It just doesn't help the case. And sometimes that happens. I can tell you many tops or bottoms with bearish or bullish engulfing candles. You get the first confirming one, consolidate for a while, and then it continues. And I've also seen many that come and blip, and it's a little down, proves to be a whipsaw. Again, it's just one of many potential type of sell signals. And then SPY as well, same thing. Bearish engulfing candle here. There's body, wiped out the body of the previous 3 candles. You had your confirming stick, and now we're getting up there. We're pushing really about what I like to see about the top 2/3 of the candle right there. And so if we rally up today, hold up today, let's just say, or regain the drop that we've had so far off the highs, and rally tomorrow, there's a potential to take that, undo that signal there on SPY. Now, most of my focus is on QQQ, and I'll tell you why here in just a second. Well, let me tell you that why now. We're on the daily chart. So I updated the holdings of both SPY and QQQ today. You might not be able to make this out on your screen, but I'll read it out to you. As of today, here's how SPY is weighted. Apple, top component, 6.89%. Microsoft, 6.31. Amazon, 3.85. Both shares of Alphabet, both share classes total 4.34. Tesla, 2.17. NVIDIA, 1.99. And Facebook at 1.99. Cumulatively, those, what is that, 1, 2, 3, 6, 3, 4, 5, 6, 7 companies comprise about exactly 27.52% weighting. So over a quarter of the S&P 500 is attributed to the performance of just these handful of top weighted stocks right there. It's even more drastic when you go to QQQ. There are a lot of the same top holdings. Apple at 11%, I'll just round off here. Microsoft at 10, Amazon at 7.82, Alphabet, both share classes at 7.8, Tesla 4.5%, Facebook 3.8, and NVIDIA at 3.7. That's 1, 2, 3, 4, 5, 6, 7 companies totaling or accounting for 48.58%. So pretty much half of the returns of the Nasdaq 100 coming from just these companies due to their very large weighting, and the weightings go down sharply from there in percentage terms. So this is what you watch, and you need these stocks to roll over, and if they do, you're going to take the market down with it, and if they don't, then the market doesn't go down now, or at least not down to those deeper potential larger targets. All right, let's show you now. Let's jump out. We already covered the weeklies, so let's go out to the monthlies, and then we'll wrap this video up. Won't be super long. Okay, so here's a long-term view of QQQ, the Nasdaq 100. I don't have all the drops measured out here. The only one missing on this board is the big drop back when the dot-com bubble hit, and that was roughly a 83% drop. This was a tech wreck. Tech took the market up and turned into a bubble, and then took the market down. So that was one of the biggest drops ever, or the biggest in the Nasdaq, of course. Then Nasdaq hasn't been around as long as the S&P. The bear market back in 2007 to 2009, 55% drop, and then you can see the other, technically speaking, bear markets, because I measured high to low. QQQ had a flash crash. Now the ETF itself dropped 26%. The Nasdaq 100 didn't, and because the Nasdaq 100 is an index, ETFs, there were some, panic selling, if you will, so you had a bigger drop there. But again, this is what we trade. You don't trade the NDX. You can't buy the NDX. You can only buy derivatives or an instrument that tracks it, such as this one. So that's what you would have wrote out or been stopped out on. 24% drop. And again, these are rough, measured high to low, rounded off. 31%, and here's where we're at. So what are we looking at? Okay, well, for many months back, actually since 2018, we were building divergences. Now the first divergent high back then here on the RSI, you can see played out for that 24% drop. Then we had divergence also, I should add it here like this, at the before COVID hit. That was right there, and that played out for that 31% or so drop. And the divergence has continued to build. We're still making lower highs on the RSI down there. The other indicator that I'm looking at here I should mention we had divergence right there as well. The other indicator that I'm looking at is the PPO, and you can see it down here. There you have the PPO lines. I have a blue and a white line, and it's hard to see them when they get close together, especially in the videos. So what I've done here, I'll park the RSI out of your way. Let's just focus on PPO action. So you can see the histogram shows you when the two lines cross. You have a 0 line on the histogram. When you go above it, it turns green. When you're below it, it's red. And that those crossovers coincide with crossovers with the PPO line, the PPO and the signal line. And it's pretty simple stuff. I'm just going to show you. When you have these big green hills, you're in a bull trend. This is a monthly chart. I don't usually go to a year. You can go out to longer term charts, but that means every candlestick's 1 month. We can go back for decades. That's usually the longest time frame that I'll use. And so when it's green, you're in a bull trend. When it crosses over to red, the trend has changed. And so early on here, it told you, hey, trend change. And then also I love that 20 period exponential moving average on the monthly time frame. Once you get a monthly close below it, which you had right there, that's it. This indicator, I've talked about it for years. It just does such a great job on QQQ and SPY, at least, of defining bull and bear trends. You know, crossover, there's all your signals. And it also roughly coincides with the crossovers on PPO. So if you had nothing else, this is your 401k trading strategy right here. You don't want to actively trade in your 401k, but when you have both SPY and QQQ, you have this PPO cross on the monthly time frame to red, and then especially once you have the confirming candlestick, the break there, that's when you should be out of longs and either into shorts or into cash or other alternatives. And then that's it. So this PPO captured almost the entirety of that bear market. That was it was the worst, again, an 80-something% drop. Then here, you would have told you to be long and stay long throughout great bull market there. You had a correction that was back in 2000, towards around 2006-07. Doesn't even look like much here, but it was. High to low, whenever we peaked, the drop was, good 16 or so percent. So yeah, you can't even call that a whipsaw because it got you out. And then again, you would have got back in here. So you can see it's worked great. Got you in early, and so did the break below the 20-month period exponential moving average before that 55% drop. So sell signal. Here, let me just speed it up for you. Sell signal. Here are a couple, you can call them whipsaws, but again, you would have got out. There was some downside in the market. But if you want, like I said, the scrubbing or confirming thing is a break below the 20-month. And so on these, you never had a sell signal on a monthly close below the 20-month. Even here, you had a dip, but it never closed below it. But it did warn you early on, okay, we have a bearish crossover. Market went up for just a little bit longer, but divergences was building. That's on the RSI that already took off 26% drop. And that, again, warned you, heads up. Okay, told you safe to get back in the water right here. You were above the 20-month, and it would have kept you long throughout that whole period there. And look at where it would have got you out. Right at the top, you would have sidestepped the 24% drop there. It's not a perfect timing indicator. We regained the 20 months, so maybe you would have got back into your positions there based on that. There was a blip there. And again, it coincided with that 31% or so drop when COVID hit. It was over before we knew it, but it was one of the biggest bear markets in decades, so it's not as if it didn't exist. It was real. It was just super fast because the actions the Fed and the federal government took. And why am I spending all that time? Well, look where we are. And usually there's no guarantees, but you can see the slope or descent of this indicator, and it's right there right now. So the month is still young. Nothing that matters on this chart counts until the end of the month, December 31st. So we'll watch on that and we'll keep an eye on that. But you can see usually when these indicators start rolling over, a cross is pretty much inevitable. Here, headed down, you had a little reprieve at the end there, a little pop. But then you crossed over. Headed down, you crossed over. Headed down, you crossed over. So That's it. I mean, anything's possible, but usually when you get down this low, a crossover is inevitable. And again, this is the longest term trend indicator, so this isn't day trading stuff. It's not even 3-4 day swing trading. That's what the 60-minute chart was for. That's why we could have navigated down. You could have covered a reverse at T1 or T2, played the bounce, get back in. But this is long-term stuff, and that when you look at this long-term chart, where are we likely going to go? Well, at least that 20-month right there, right? Last time we checked it, we tested it successfully. When COVID hit, look at that. There was no sell signal. We didn't break that. So the short brought us back to that level. In hindsight, you could have went long on that. The month that closed the month right above it, I think you can see the bottom of that candle. That's where we close. It's a red candle, so we close right there, right above the 20-month. In the following month, again, intra-month went below, but we ramped up and closed the month solidly above it. So that kept this whole trend intact. The last time we've had sell signal in that monthly was back there in the great bear market, the Great Recession back in 2000 when the top market topped in '07. So that's it. Now, where am I going? Well, we're not going to break it anytime soon, so we're not at risk for that. But again, what happens on a key moving average is you come and check it every now and then. You visit that moving average, and it keeps the trend intact. So even if you're just looking for a pullback to that moving average, that's still about that 17-18% drop or so I've been talking about. And unfortunately, for the bulls, or for the market, that is, this says, hey, we're looking at probably more than a 17-18% drop. We'll probably come and test the primary long-term bull market uptrend line that comes off the 2007, late '07, late '08, early '09 lows right there. That's another beautiful, well-defined trend line. It's been checked on all these arrows, and it's been a while. So that's the longer-term target. The only way we're going to get there is if we first get some confirming sell signals and additional support levels that break on the daily chart. We get those bearish engulfings on the weekly firmed up with either a red candle this week or maybe next week. We'll see. So that's that. Now, there's a little bit more here. Stay with me and then we'll wrap this up. S&P 500 looks great, right? S&P 500 is comfortably above that level, but again, it's all about tech. That's why earlier I showed you the top components, and if the Nasdaq 100 goes down, it breaks down everything I just talked about, the FANGs, Facebook, Amazon, Apple, Microsoft. They go down with it, and they're going to take the market down hard because they've carried the market up, and they'll pull the S&P 500 and the financials and everything else that's not in the Nasdaq 100. It'll get pulled down with it. A couple others to look at here would be IWM, small caps. Look at this. Small caps are right there. Look at the PPO histogram is reading 0.01. Let me turn off all the other lines. Right here you can see 0.01 is the reading. Means it's pretty much on the line. Now, again, anything is possible, but if you were a betting man or woman, which you are when you're playing the markets, what do you think is going to happen? Now, we could bounce. Sometimes, look like we're going to cross right there, and we didn't. We bounced. There was each bar is a month. So 1, 2, 3, 4. We went up for another 5 months. But then ultimately, the technicals played out, and you got this, and you got what you got from there was a drop of on the initial leg down was 27.5%. Before all said and done, from that top, extend that, the small caps dropped 45%. So pretty good stuff, and look, pretty damn reliable. Not many whipsaws. There's red. There's a crossover. Measured, I can tell you right now, it was about 2 years. That, yeah, you went a little higher, but if you took the signal and you stayed short, it was marginal. You could have stayed short, you would have hardly been underwater, and you would have been quite profitable. Or again, maybe you don't short, you would have been glad. It would have been a year and a half, 2 years of pain being in the market, watching your portfolio go down, then up a little, maybe get back to where you were, and then the big drop. So again, you want to be out of these periods here when you get that PPO crossover. One before that was right here. There was your signal. It didn't fire early on, but there was still a considerable drop left in it. You had it here, right there, and that got you out of the entire, or almost the entire bear market back then in 2007, 2008. Small caps from high to low fell 50, almost about 60%. And again, there it is. So, and then now let's go back to the Qs. All right, so I showed you the Nasdaq 100, QQQ. Showed that's close, but guess what? I've talked about in recent videos the extreme weighting that the big fangs have and how unbalanced the Nasdaq 100 is because it's a weighted index. So we can do one of two things. We can go to QQQE, which is the equal weighted, or NDXE. QQQE is an ETF that tracks the index E. NDXE is the equal weighted Nasdaq 100, where it has the same components of QQQ, but they have it all in equal weighting. And guess what, guys? Boom. So if you look under the hood, I talked about deterioration of market internals. Bingo. We fired. Actually, we fired last month. Last month said, hey, heads up. Now, is it going to help to see the indexes that most people trade breakdown? Like, in other words, very few people have QQQE. Most probably trade QQQ. Great when the fangs are lifting everything up because that overweighting helps. But again, under the hood, we've seen serious breadth deterioration. Market internals worsening. And again, last month we had an official crossover there. Last one was right there. Again, came and this thing was over before we knew it, but that drop was associated with the biggest drop in years. So let's just do this again. Let's look at the bars. You want to be long when this indicator crosses over. You did it here. Yeah, you went up a little when it first triggered, but then it dropped a lot more than you went up. So you were profitable. You wouldn't have been stopped out. A reasonable stop would have stayed unhit. And then, yeah, there was buy signal there. And again, use it in conjunction with that blue line, the 20-period monthly average. So we're not even there yet. But with this crossover, probably going to get us there. We'll roll back, look at a few more, and then I'll show you one more index, two more, and we'll wrap it up. There's a period of red. Actually, it started right here. And again, you sidestep 2 years. If you remember, 2015 to late 2016 was this down to sideways market. So even if you took out your 401k, got out of the market, you got back in right where you started. Especially when again the 20-month was recovered. That would have been your re-entry point right there. You can see again just how well it acts as support and resistance. Don't look at these little skinny parts or above. It's the candle where it closed the month. And so you have these intra-month breaks, maybe an occasional whipsaw, but overall done a phenomenal job. This is when you want out. When you clearly give that breakdown. You broke down in early 2007, late 07, early 08. You back tested, rejected off that level there. And that's it. So we have two more indexes I'll show you, but let me just finish here. Got you out there, and of course, using that indicator, you would have been out of the entire or the bulk of the bear market back in 2007 to 2008. The other one I want to show you, because the NDXE doesn't even go back that far, the Nasdaq Composite. Everyone, talks about the Nasdaq 100, or I do a lot, but COMPQX. There we go. We can roll this one back quite a ways. And so the Nasdaq Composite are all the components of the Nasdaq Composite Index, not just the top 100. And you can see, boom, the month is still young. I have to say that. This is a monthly chart, so unlike QQQE or NDXE, which had a confirming sell signal or bearish cross last month, this candle's still in play right here, or this bar, this histogram bar. So if we can rally pretty strong into the end of December, and historically, seasonally, it's a bullish month, I'll admit that, and but the problem with trading that is, every now and then, seasonal bullishness or bearishness doesn't always play out. So let's just take it as it comes. Right now, these lines certainly look, well, they have crossed, and they look to finalize. If we ended up where we are now, or unless we rally up significantly, we're going to close the month with a sell signal on the Nasdaq Composite via the PPO. Again, there's many kinds of sell signals. That's just one. And you can see again, what happened after we get these crossovers, sideways to down markets. That was early on in the bull. But, in a late, if you're looking where we are, it's hard to argue right now we're in late stage bull market action. And that's what happened back there. Got you out. And you sidestepped the big drop into the 2009 lows. Last one I'll just mention, the S&P 500 is one of the best benchmarks for the U.S. economy or the U.S. stock market. Because it has the 500 largest companies in the U.S., U.S.-based companies. But the Wilshire 5000 covers many market caps, all the different market caps, and it's probably more representative of the overall market. So this is one we'll watch as well. And again, like the S&P right now, it's currently on a buy signal, but it's certainly heading lower. And so it's a matter of when it's going to cross over there. You had a little whipsaw, but then the big cross came right there. So again, same thing. This is when you want to be out. When these red periods are going on, that's when the big drops come, and we're certainly headed that way. But monthly bars, again, it all depends how fast or slow things move. We could there's a infinite number of possibilities. We could move lower for a few more months, then cross. We could even bounce for a while. This indicator can come up like it did back here and then cross over. But these are the things I'll be watching for. And I did want to mention that, like I said, the Nasdaq Composite and equal-weighted Nasdaq 100 have made their crosses, and those are the most important stocks, the tech-heavy Nasdaq 100. Hey guys, that's it for the markets. I just wanted to mention that after I did that video earlier today on the educational stocks, the first one, the one that I've had on my radar for a while, and that I had a price alert on recently and meant to cover in the video. So what I had to do, I went through the list of all the components, flagged them all, but not the one I started with. And this is the one I keep coming back to the list. I don't even, it's easier to pull the watch list. I type this in and then TC2000 loads all the components. It was COE, and so that was the first one that I noticed today. And then I just realized after that video that I didn't flag it, so then it didn't. I don't believe it was covered in the video. Maybe I did cover it, but if I didn't, just want to mention it's moving nice today, and it's at the trend line now, the downtrend line, and the target on that one's 223.365. Again, I might have covered it, but I noticed that it wasn't flagged, and so unless I started out with it in the video, I cycled through all my flagged items, it may not have been. So that's it. And the rest of the sector still looking good, but again, that's a whole nother video. I'll let you take a look at that when you get time. I'm going to wrap it up here, and we'll most certainly continue to monitor the market. But if nothing big happens today or early tomorrow, I'll certainly do a weekend update and take a look at where things closed on the broad markets. But remember, there's always a lot of fish to fry. Broad markets are one thing. It's easy to trade because they're very liquid, but there's a lot of other trading ops out there, and commodities, bonds, precious metals, all of which I'll update soon, either later today or get to those tomorrow. All right, I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.